Hello, Business 330 students. This is Professor Hasse. This is our week 3, the week of June 19th through the 25th lecture video for our Business 330 summer sessions course. Today's date is Wednesday, June 21st, a little bit late this week. I was traveling over the weekend and got in a little bit day later than I planned, but we're back here in Claremont and ready to tackle week 3, the past, present, future in finance, better known as the time value of money. So let's see where we are in our course beginning this week 3. I have posted assignment number 1, grades and solutions. Some students have yet to post. They're posting today and tomorrow. And once they post, I will give the solutions entirely to the whole class and the grades. But if you have completed your work, I have posted your grades to Blackboard, and you can see your performance on it, and everybody's performance was very good. Again, as your grades are posted, you just go to the report card section on the front page of your Blackboard, click on the letter or the grade there, and it will give you the details in your grade center of what makes up that grade and all the files that I've returned for you. What I do is once I grade the files, I reload it back into your grade center, and you can download it and see what you got wrong and my highlights of that. If you did not see a file in your grade center, it means you got a 100. So there's no need to send you back a corrected file. Again, for this week, since we do have some students still working on their assignments, I have posted the solutions to your individual grade center file. And once all the students have posted, I'll post the solutions to the entire assignment number 1 file folder. So here's where we stand in class as of beginning this week 3. We have completed the student bio and portfolio section. Matter of fact, in assignment number 3 in another week, you will have some work to do with that portfolio again. You have seen and had your professor meetings. You've completed assignment 1 and the grades are posted. And this week, an assignment 2 is posted to the assignment file folder, and you have to Sunday, June 25th to complete that assignment, which is on our topic for this evening, the time value of money. And here is the assignment number 3 file folder with our learning assignments for this week. Later on at the end of this week and with my weekend video, I will also post the Road Kings assessment case paper, which is not due until July 30th, but I'm going to post that this week, and you can begin to read it, and we'll have subsequent class sessions on that assignment as well. Here's a file that I'll be giving in my lecture video tonight of review of different concepts in the time value of money. And our finance fact this week, we've already talked about the S&P 500. We've already talked about the Dow. Now the NASDAQ index is our financial fact this week to explain those market indicators. And a variety of other information that helps you understand the time value of money. So I hope the course is going well for you all. Remember, we have student hours every Thursday evening from 6 to 8 o'clock. If you'd like to review your assignment number 1 or go over any content of assignment number 2, please feel free to be, I'm available every Thursday evening and also through the discussion board and through email as well. So let's take a look at the time value of money. Okay, here's a spreadsheet that's located in week number 3 that explains the key points of chapter 5 and the time value of money. Remember from our accounting days, one of the key important financial statements is the balance sheet. Assets equals liabilities plus equity. Liabilities are debts, both short-term, accounts payable, and long-term, bonds, mortgages. Equity is stock issued by the company to investors, and retained earnings, the amount of profits the company retains after they distribute dividends to the shareholders. The combination of debt and equity equals how assets are funded. And what are assets? Assets are buildings, inventory, land, cash, receivables, computer systems, anything that produces a return, an asset, something you own that produces revenue, produces profits, hopefully, produces cash flow. To get those assets, you borrow money and issue equity. That's the core of the balance sheet and the core of corporate finance or any finance. It's always important to understand the concept of what assets are valued at any point in time. What is their present value today? What is their future value based on the potential of earning and growing into the future? How do you measure that growth? It's these three areas right here. The principal, how many dollars are invested in that asset? The interest, how is that interest going to, what is the amount of growth rate of that asset over time? Also, what did it cost you in interest to acquire that asset? And also the time period involved. How long do you own the asset? Not how long you own the asset just owning it, but how long financially do you own the asset? If you guys remember, if you remember the depreciation from accounting, depreciation is how you depreciate a fixed asset over time. Well, we're given depreciation schedules that set the length of time of depreciation. 1 year, 2 years, 3 years, 5 years, 7 years, 10 years, 15 years, 20 years. That's how long you depreciate. That's the time involved in calculating the value of an asset, the depreciation or expected life of the asset financially. So to know all these terms, you can determine the future value of money, the present value of the money, the present value and future value of cash flows. And this is what chapter 5 is all about, understanding how to calculate that. Now you can use a calculator, you can even use your cell phone, but in this course and courses in your business program, you use spreadsheets to calculate and make these calculations. One of the key functions of a spreadsheet is what is called formulas. The formula function or the formula table in a spreadsheet, be it Excel, Google Sheets, Mac numbers, the formulas, and you have functions to do those calculations. That's what we'll be doing in this spreadsheet to highlight some of the problems of chapter 5. You'll be asked to do these calculations in assignment 2. You'll be asked to do these calculations in your case paper in this class, on your midterm examination, on your final examination. All these calculations are necessary to do and understand as a part of financial management. So let's look at problem 4 from chapter 5. It asks you to determine the future values of $100. I have $100 today and I invested. I invested at an annual expected growth rate over a period of time. What is that $100 going to be worth at the end of that time if it's compounded annually at that interest rate? In other words, what is the future value? The principal is $100. In this case, the interest is 8%. In this case, the time period is 10 years. So I go to my function and formula calculation on my spreadsheet. Formulas, function. And now I bring up a series of functions. I go to financial, the pull down menu, and pull down financial. And now I look for the future value function, FV. There it is right there, FV. I hit OK. And now I can put in the information of principal, rate, and time, and I can calculate the future value of that $100. First of all, the interest rate in this example is 8%. The number of periods are 10 years. I'm not making any payment. This is not an annuity. I have a present value of $100. What is $100 going to be in 10 years compounded annually at 8%? Notice I typed in minus 100. If I put just in $100 there, the number will still be the same, but it will be in a negative number. To avoid confusion, and how the logarithm works is you put in negative principal, present value, because that's indicating I'm spending the money today. I get $215.89. That's the future value of $100 at 8% for 10 years. Now, what would that value be if I had a lower interest rate? Same calculation, just I use a different parameters. Financial, FV. Now the interest rate is not 8%, but 4%. I just type in interest rate of 4%. Still 10 periods, and still the present value is minus 100. And notice I get $148.02. So $100 plus 8%, $100, that principal plus 8% plus 8, 10 times, I get $148.02 at 4%. Now let's say I make the period longer, 20 years, same $100, same interest rates. Function, future value, FV. I want you to practice these on your own and see if you come up with these numbers. 8%, 20 periods now, 20 years, same present value, minus 100. And notice we're going to naturally make more money. The investment is going out longer. Then we have, let's do the same calculation at 4%. As long as you get a handle on these functions, naturally in Mac numbers, they set up a little bit differently, but the same format is basically the same with the parameters. Here, now the rate is 4%, 20 periods, and still minus 100. And there you go, 219.11. So that's how you calculate the future value of a number. I got a number now. What's it going to be in the future? Compounded, in this case, annually. Now, if this was compounded at quarterly, all right? If this was compounded quarterly, the calculation would be this: 8% annually, but compounded quarterly for 10 years. So I would go to the same format, function, future value, but now the interest rate is quarterly. So that means it's 2% per period, right? 8% annual, there's 4 quarters in a year, so that's 2% per period. But now it's for 10 years compounded quarterly, so that's 40 periods, right? 2% 40 times compounded quarterly. The present value is still 100, but look what our number will be, 220.80. Notice at 4% or 8% compounded quarterly, I'm making about $5 more than I am if it's compounded annually. Okay, in this case, that doesn't sound like a big deal, but if you're looking at thousands and millions of dollars, that is a big deal. So one of the key things is understand, what is the time period? Is it annually, quarterly, like our savings accounts at our banks, compounded daily? And then you would take the annual interest rate and divide it by those number of periods in the year to determine your interest rate per period. That's important to remember. Okay. Now let's say we want to take a look at what would be the value of $100 in the future and what is its present value today. Okay. For example, right now, we calculated the future value of $100 as being $215.89. Okay. What is its present value? Well, we're just going to go the opposite way. We're going to take $215.89 and discount it back to today. It's called discounting. All right. But let's say we're going to use the inflation rate to determine this. So let's say I'm investing money at 8%, but my current inflation rate is 5%. So that's going to knock 5% off the return over those 10 years because that's my interest rate or cost of money. So let's say I go in now to formulas, function, and now I go to financial, but I now go to present value, PV, I'm determining the value today of a future amount, present value. So my interest rate would be the inflation rate, 5%. That's my cost of money. Number of periods would be 10. And the future value would put in $215.89, which is the future value of that $100. So now we're taking into account inflation, and are we still going to make money off that investment? Well, notice the number is $132.54. So yes, taking into account inflation, we're making $132.54 on that $215.89. So we're losing quite a bit, but we're still making $32 of the original investment, taking into account inflation. We're earning 8% a year, but our cost of money is 5%. That's our discount rate. So that's what it's truly worth at the end, at today, taking into account inflation. Does that make sense? So naturally, the higher the inflation, the more it cuts into the present value of that generated asset. Let's take a look at inflation with our 10 years at 4% interest rate. And this is going to be something very interesting. Watch this. Formulas, function, excuse me, financial present value. The interest rate now is, the inflation rate is 5% like it was before. It's still 10 periods, but now our future value is 148.02, because that's the 4% earning over 10 years. What is our investment worth? $90.87, and that's a perfect example of inflation. When our return is 4%, but the cost of money and inflation is 5%, notice my value is actually less than my original investment. Inflation is eating away that return. And that's what's going on exactly today in the markets. The return on the investment is less than the inflation rate. You're not making, matter of fact, you're losing real money. And that's what's freaking out a lot of people these days in these economic times of high inflation. But that's a perfect example. So let's take a look at this in terms of the 20 years. All right, now it's out a little longer, but the interest rates of compounding are staying, so is our inflation. So let's take a look at 20 years at 8%. We go back to the present value function. Now the inflation rate is still 5%. We're looking at 20 periods. And what's our future value we're looking at? 466.10. What is that present value? Okay, 175.67. We're still making money, but we're losing quite a bit over those 20 years to inflation. And that's making the example that 5% is going to be inflation rate for every year, which probably will not be the case, but that's just for the sake of argument. So let's take a look at the 4% for 20 years. Function, present value. It's good that you practice these, because we're going to be doing a lot of this, and you'll be doing a lot of this in other courses as well. 5% inflation, 20 periods. Now it's at 4%, so our future value is $219.11. Whoops, we're really losing money here because it's out longer, 20 years. So notice it's well below our original investment of $100. If I'm earning 4% in inflationary times over 20 years of 5%, boom, we have to find a better investment there. So again, this is the dilemma in financial markets today, is that lower interest rates are lower and return rates are lower than inflation. That cuts into the value of the assets over time. A very key, important concept in finance. And there's two examples: future value, present value of money. Future value is taking a sum of money today. What is it worth in the future? Present value is taking money in the future. What is it today at whatever discount you're using? And inflation sometimes is the discount rate. And when we get to our case paper in a couple of weeks, the weighted average cost of capital for a company is our discount rate. Clear as mud, huh? Well, let's take a look at another example of present value. Is what is the true value of a flow of money into the future? What is it worth today? All right. So here's an investment. I'm investing $700 in an asset, and that asset is going to generate $200 of return profit the first year, $400 in the second year, and $300 in the third year. Well, if I total all those up, that's $900. So I'm investing $700 today to get $900 in the future over 3 years. Now, when you think about, look at that, you go, that's pretty good. I might do that. I'm making money. I'm making $200 of my original investment. But remember, how did you get that $700 to invest in the asset? Where did that money come from? It had to come from someplace. Did you borrow it? Did you issue stock? Did you use past profits? Did you use money from a savings account? Did you use money from an existing investment to cash out and use that 700? Yeah, that money, that capital had to come from someplace. And this is where we get the cost of capital. It cost us 6% to get this money of $700 that's going to generate $900 into the future. So what is the true value of that money today? Well, we will determine the present value of each one of these dollars and see what that totals to today's value. And how does it compare to the $700? So, okay. So I'm making $200 in the first year at 6%. So I go back to my formulas function. And now I remember I'm taking money in the future, $200. What is it today? So that's present value, PV. The interest rate is 6%. That's our discount rate. This is for 1 year in the future. And its future value is $200. What is that $200 worth today? $188.68. Okay, cool. $400, year 2. What is its present value? PV. %. Now it's not 1 period, but 2 periods, 2 years ahead of time. We're earning $400 as the future value. That present value is $356. Cool. And the last year, year 3. Present value, %6 is our cost of money. Now it's 3 years out, and the future value is $300 minus 300. We get $251.89. So that's the present value of that $900 discounted at 6%, which would it cost us to get the $700 of investment. What is this total? That totals $796.56 at a cost of 6%. In other words, we're still making $96.56. We're not making $200 because we're taking into account the cost of capital. Now that cost of capital could be the inflation rate if you want to, or it could be what it actually physically cost you in interest to get the $700 to invest. So notice I'm still making money, but not as much, but it gives us a better perspective of the present value of that investment based on the amount of revenue or, profits that will generate. Now, if you notice, this was kind of cumbersome. We had to go year by year by year to calculate this. What happens if we had a project over 20 years? Well, this gets a little monotonous. There's a way of combining all these into one calculation, and I want to show you that right now. It's right over here. Formula, function, and instead of looking at the financial function PV, I want to look for NPV, net present value. There it is right there, net present value. Again, the rate is 6% still, but now I'm going to lump all those values into one line. I'm now just going to go back to my chart here and just paint year 1, 2, and 3. And notice in the values in the formula, it puts in the cell numbers, D25 to D27. That's taking in those 3 years. All I have to do now is hit OK, and golly Gomer, I still get 796.56, just like I did here, but in one keystroke, one formula, I did all that work. This is going to be very helpful when we look at capital budget analysis in our case paper, looking at 20 years of cash flow and discounting them back into the present value, just like we're doing here. But here we're only using 3 years. 20 years, this one calculation using NPV, it combines the 3 years, is going to be helpful. Okay, let's make sure we save this when we're done. So we've looked at future value, present value, and present value of what is called an annuity. Annuity means a series of payments in the future. What is its present value? Now, one last thing to look at. It's called amortization. Now you might think, what the hell is amortization? Well, you guys deal with amortization all the time, especially if you are running your own personal finance. You got a car loan, that's an amortized loan. You got a mortgage, that's an amortized loan. Whenever you have a loan on an asset, like a car or a house or whatever, and you pay monthly payments, equal monthly payments on that car over a period of years, that is what is called an amortized loan. You're making equal payments, a payment every year, and over the course of those years and payments, you're paying off the loan and meeting your obligations for that liability. It's called an amortized loan. Now, in our studies, I'm not going to ask you to do this table that I'm going to do. I want to show you how it all works, but I need you to know the definition. An amortized loan is a series of equal payments over time. A non-amortized loan is interest payments only and principal at maturity. That's what a bond is. Interest only. Amortized loan is a series of equal payments where you're paying interest and principal every payment. And that's why most of us have amortized loans, because we do not have the credit or the collateral to have interest only loans. We don't have that financial power. Corporations have that financial power, so they can issue bonds interest only. We and smaller businesses can only pay amortized loans, and that's an important concept in debt management. Okay, so let's look at this example. I'm going to buy a car for $40,000. Can't be much of a car, but for $40,000. I'm going to put down a down payment of $2,000. And so I'm going to ask for financing over 4 years, monthly payments over 4 years of $38,000. My current FICO score is about 650. That's my current FICO score. Remember, FICO score is anywhere from 300 to 900 of your credit worthiness, your risk in the market. So my credit score, FICO score, is about a little bit above average, 650. So I qualify for a 4.5% interest rate annually on this loan of $38,000. All right. So this loan is for 4 years, but I'm making monthly payments. So that means I'm making 48 payments over 4 years. My interest rate per year is 4.5. So I'm going to need to calculate what is my interest rate per period in order to calculate my monthly payment. This is what the credit unions do, car finance companies, mortgage companies. This is how they calculate your monthly payment. So if I go into a formula equals, if my annual interest rate is 4.5%, so I put in 0.0445, and I divide that by 48. That's 48 months, 4 years, 12 payments a year. I get an interest rate per period of 0.0009375. That's roughly 0.094%, but that's the decimal. So what will my payment be on this $38,000 loan at that interest rate per period for 48 periods? Formula, function. We've been there before. Financial. And now I look for payment, PMT. There it is right there, the payment function. And I can calculate my monthly payment. It says here, calculate the payment for a loan based on constant payments and a constant interest rate. Our interest rates, this is not a flexible rate. It's interest rate for the full 4 years. So I bring up that interest or bring up that function. And now the interest rate, now I type in the decimal, 0.0009375. That's my interest rate per period. There's 48 periods of this loan, 4 years, 12 a year. And there's the future, the present value of this loan, all right? Excuse me, the future value of the loan, what I'm going to pay back after you make your payment is excuse me, my computer froze up just for a minute. I had to stop it and restart it up again. Such are the problems of modern technology. So again, let's go back to it. We're determining the payment on this loan of $38,000. So again, the interest rate in decimal is 0.0009375. That's the interest rate per period. The number of periods are 48. This is where we were, 48 periods. And the the present value, we're borrowing minus $38,000. There's our payment, $809.98 every month for 48 months. All right, that payment is going to be determine my paying off this $38,000 loan. Now, what would be the amortization schedule for that? Well, we're borrowing $38,000 in payment number one, period number one. Our payment is $809.98. Why don't we just do this way? Equals $809.98. Our interest on our loan right now for this first payment, well, if we take $38,000 times our interest rate per period, 0.0009375. And remember, I'm not going to ask you to do this. I just want to show you how it all works. There's my interest rate per this first payment. I'm taking the principal times my interest rate per period. So that means my principal, the amount I'm paying down on the loan, is the difference between the payment and the interest. So I'm paying, that's how much I'm paying down on the loan, this first payment. So my ending balance then will be, I'm taking the 38,000 minus the principal payment, and there's my balance. Oops. All right. I have a very loud, dirty keyboard and I can't see. Oh, there we go. Minus the principal. And there's my principal balance at the end of the first payment, and that balance goes down here. So now I start it all over again. So watch what happens. If I just take this series and copy it down to here and go all the way down to 48 payments and hit paste, there's my loan being paid off, all but 18 cents, and that's probably due to rounding. So as you can see, my payment, I'm making $38,879.04 in payments. There's my interest. The balance will be the principal. I'm off 18 cents, and that's because I probably didn't round it properly. But that's how an amortization loan works. Again, you do not have to do this table, but I wanted to see you. This is how a car loan, a mortgage works. It determines the principal and interest portion of the payment. You pay off the loan in installments, and that's why at the end of specific time periods, at the end of the first year, at the end of 12 payments, there's my balance. At the end of the second year, there's my balance. At the end of the third year, there's my balance. And at the end of the fourth year, I'm paying it all off. So that's what we want to do. That's what that means. But the key point in our discussions is not that you can calculate this, but what does that mean? Amortize means equal payments over time where principal and interest are being paid off. Unamortized loans are interest only. This concept will be more apparent as we get into our studies in the next couple of weeks. But that's the concept of present value in Chapter 5. Future value, present value of annuity, series of payments, and amortization. We're going to be mainly concentrating on present value of annuity when we get to our case paper, where we're going to be doing an analysis of 20 years of cash flow off an investment. What does that mean? But also in assignment 1, you'll be doing these types of calculations as well. So let's take a look at assignment 2, excuse me. Let's take a look at assignment 2. So here is assignment number 2, due Sunday, June 25th. And remember, if you need extra time, your extensions are available. It's just a series of calculations about what we just talked about from Chapter 5. What is the future value of $10,000? What is the present value of $50,000? You'll be receiving cash flows into the future. What is its present value? If you had $120,000 mortgage, how much interest will be paid over the life? All examples of money, either in present or the future, and calculations to do that. You can download the Word doc file and put all your answers on this sheet. You don't need, I don't think, an Excel file. If you'd like to use an Excel file, naturally to do your calculations, go right ahead. And then in question 2, I ask you to do a real world application. Please give an example from your professional or personal business life of present or future value. Example would be your savings account. You have money in the account at a specific interest rate. What would be the balance in 1 year? A mortgage, a car loan, specific investments. Your example should be an instrument of present or future value and explain how these values are used in your example. So just give a real world example of these concepts from Chapter 5. Okay, so that's our work for week 3. We've now taken a look at financial statements. We've taken a look at the basic definitions of finance, and now we take a look at the time value of money. All heading to next week in week 4 when we talk about capital budgeting and use all these first 3 weeks concepts into learning about determining the return on investment of a capital asset. So good luck with assignment 2. Remember, we have student hours on Thursday evening. If you have any questions or need some extensions on your work, please feel free to ask. Remember, solutions and your grades for assignment 1 are now posted. Have a great week, everybody, and we'll see you at the end of the week. Adios.